ever pondered on the importance of capital in the financial world? Let's delve into this intriguing concept that serves as the lifeblood of our financial system. Capital, in its simplest form, is the wealth or financial resources that individuals, companies, and countries use to produce goods and services. There are different forms of capital, each playing a unique role in the financial world. One of the most commonly known is financial capital. This is the money used by entrepreneurs and businesses to buy what they need to make their products or provide their services. This could be anything from raw materials to machinery, or even a factory. Then there's human capital, a term that might be less familiar but is equally important. This refers to the skills, knowledge, and experience possessed by an individual or population, viewed in terms of their value or cost to an organization or country. It's the reason why companies invest in training and development, and why countries focus on education and skill building. Physical capital, on the other hand, is the collection of physical assets a company or country uses to create a product or service. This includes buildings, machinery, equipment, and anything else that can help in the production process. Capital plays a vital role in the world of business and economics. It's the fuel that drives economic growth, allowing businesses to expand, hire more people, and produce more goods and services. Without capital, a business can't function, just as a car can't run without fuel. In the grand economic picture, capital contributes to the development of industries and economies, fostering innovation and improving living standards. It's a key player in the financial game, with its presence influencing decisions from the smallest startups to the most powerful nations. Understanding the concept of capital sets the foundation for our exploration into its advantages and disadvantages. With this knowledge, we can better grasp why capital is such a hot topic in the world of finance and beyond. Capital, the lifeblood of the economy, holds immense benefits. But what are they? Capital, in its simplest form, is the money or resources that businesses use to produce goods and services. It's the machinery in a factory, the technology in a startup, or the money in a bank. But it's not just about the physical assets. Capital also includes the intellectual prowess, the skills and talents of the workforce that contribute to the creation of wealth. One of the most significant advantages of capital is its role in economic expansion. Just as blood flows through our bodies to nourish every cell, capital flows through the economy, enabling businesses to grow, hire more staff, and produce more goods and services. This growth leads to higher incomes and improved living standards, creating a ripple effect that benefits everyone. Capital also fosters innovation. It provides the financial backing for entrepreneurs to turn their brilliant ideas into tangible products or services. It allows businesses to invest in research and development, pushing the boundaries of what's possible and driving technological advancements that shape the future. Moreover, capital provides a cushion for businesses in times of financial distress. It's the safety net that allows businesses to weather economic downturns, maintain operations, and keep employees on the payroll. It's the lifeline that can mean the difference between survival and bankruptcy during tough times. But capital isn't just about surviving, it's also about thriving. Capital can be leveraged to create more wealth. It's the seed money that can grow into a profitable business. It's the investment that can generate returns. It's the resource that, when managed effectively, can multiply and create more capital. However, while capital is undoubtedly beneficial, it's important to remember that it's not a magic wand. It requires careful management, strategic planning, and responsible use to yield its benefits. Capital, therefore, is a powerful tool when used effectively. But it's not all rosy. While capital has its benefits, it also has its drawbacks. What could they possibly be? Let's delve into the dark side of capital. One of the most glaring disadvantages is the potential financial risk involved. When a business invests its capital, there's no guarantee of success. The market can be unpredictable, and even the most calculated risks can lead to losses. This is especially true in volatile markets, where the value of invested capital can plummet, leading to financial distress for both businesses and individuals. Next, we have the pressure to generate returns. When capital is invested, whether it's in a business venture or the stock market, there's an inherent expectation for it to grow. This pressure can lead to stress and hasty decision-making, which in turn can result in poor business choices or misguided investments. Now, let's talk about the potential misuse of capital. In the wrong hands, capital can be used to fund unethical activities, or it can be squandered through poor management. This misuse can lead to financial ruin, damaging reputations, and even legal repercussions. Beyond the financial implications, capital has societal consequences as well. It can contribute to wealth inequality, a growing concern across the globe. When capital accumulates in the hands of a select few, it deepens the economic divide. This wealth disparity can lead to social unrest and hinder economic development, as the majority of the population lacks the resources to contribute to the economy effectively. Finally, capital can lead to overconsumption and waste. With ample resources at their disposal, individuals and businesses may be tempted to consume more than necessary, leading to wasteful practices. This overconsumption can strain our planet's resources, causing environmental damage. As we can see, capital is not without its pitfalls, underscoring the need for responsible management. This journey through the disadvantages of capital is not to discourage its use, but to highlight the importance of prudent and ethical management. Capital, like any tool, can be beneficial or detrimental, depending on how it's wielded. The advantages and disadvantages of capital present us with a delicate balance. How do we navigate it? Capital, like a double-edged sword, can be a tool for growth or a harbinger of risk. So how do we balance the scales? How do we maximize the benefits and minimize the drawbacks? Let's dive deeper. Firstly, let's consider responsible investing. This is not just about pouring money into ventures, but about making informed decisions. It involves evaluating the potential return on investment against the risk. It means investing in businesses that are financially sound and have a strong track record. It also means diversifying your investments to spread the risk. Think of it as not putting all your eggs in one basket. Next, we have ethical business practices. Capital can be a force for good when it's used responsibly. Businesses that prioritize ethical practices not only build trust with their stakeholders, but also ensure long-term sustainability. It's about more than just making a profit. It's about making a difference. It's about contributing to the economy, creating jobs, and driving innovation, all while operating within the boundaries of what's right and fair. Government regulation, too, plays a crucial role in balancing the pros and cons of capital. It's the government's job to ensure that the capital market operates in a fair and transparent manner. This includes implementing laws to prevent fraud, promoting competition, and protecting investors. It also involves managing the monetary policy to control inflation and stabilize the economy. Understanding and managing the risks associated with capital is the key. It's about being aware of market trends, economic indicators, and potential threats. It's about being prepared for the unexpected. It's about making strategic decisions based on solid research and analysis. The effective management of capital, therefore, lies in striking the right balance between its benefits and drawbacks. It's a delicate dance, a balancing act, but with the right strategies and a responsible approach, we can harness the power of capital to fuel growth and prosperity. Capital, a cornerstone in the financial world, is a double-edged sword. Let's quickly recap. Capital, as we've discussed, is the lifeblood of business and finance. It's the resources, financial or otherwise, that are used to create wealth. Whether it's the money you use to start a business, the assets a company has, or the investments that fuel economic growth, capital is the driving force behind it all. The advantages of capital are many. It allows businesses to grow and expand, bringing new products and services to market. It fuels innovation, as new ideas need capital to turn into reality. It creates jobs and boosts economies. When used wisely, capital can be the key to prosperity and progress. But capital isn't without its drawbacks. It can lead to inequality, as those with more capital often have more power and influence. It can be risky, as investments can lose value and businesses can fail. And it can create a focus on short-term gains over long-term sustainability. Balancing the pros and cons of capital is crucial. It's about making sure the benefits of capital, growth, innovation, and economic vitality are harnessed, while the downsides, inequality, risk, and short-sightedness, are managed and mitigated. It's about understanding that capital is a tool, and like any tool, it can be used for good or ill. This balancing act is not easy. It requires careful thought, informed decision-making, and a commitment to fairness and long-term sustainability. But it's a challenge we must face if we want to make the most of the opportunities capital provides, while avoiding the pitfalls it can present. While capital can be a catalyst for economic growth and innovation, it's crucial to remember the risks and challenges that come with it. Understanding capital in the financial world, therefore, is key to making